Strong US CPI spooks global investors, lifts dollar. US stocks hit a one-month low on Tuesday amid the ongoing speculation that rising inflation pressure could prompt interest rate hikes sooner rather than later, despite the Fed's Powell being steadfast in his view that it's too early to talk about policy changes. On the data front, March job openings rose to 8.1 million, the highest number recorded since December 2000. Still, the S&P 500 fell 0.87%, the Dow Jones Industrial Average sank 1.36%, while the Nasdaq Composite lost just 0.09%. Asian stocks were mixed on Wednesday, with China's Shanghai Composite and Hang Seng in Hong Kong gaining 0.61% and 0.78% respectively. The Kospi in Seoul shed nearly 1.5%, and the S&P ASX 200 in Sydney fell 0.73%. Japan's Nikkei 225 shed 1.61%. In Europe, stocks closed higher on Wednesday as strong regional earnings reports and signs of speedy economic recovery offset concerns about a rapid rise in U.S. prices. The Pan-European Stoxx 600 index rose 0.3% after falling almost 2% in the previous session. In London, the FTSE 100 gained 0.82%, the CAC 40 in Paris was 0.2% higher, as well as Frankfurt's DAX. Data showed Britain's economy growing by stronger than expected 2.1% in March. In individual stocks, German lender Commerzbank rallied over 8% after the bank beat expectations for the first quarter profit and raised its revenue outlook. The German bank said that it had a quarterly profit of 133 million euros compared with a loss of 291 million euros a year earlier. Revenue rose almost 35% to 2.49 billion euros. The better-than-expected performance was largely attributable to net commission income from securities trading. The U.S. rate of inflation has hit 2.6% in the 12 months to March, the highest level seen since 2008, and breaching the Federal Reserve's 2% target. For most of the past decade, the rate of inflation has hovered well below that mark. Furthermore, the Consumer Price Index soared 0.8% to match the biggest monthly increase since 2009. Against this backdrop, Wall Street's benchmark S&P 500 index recorded its biggest one-day drop since February, as investors worry surging inflation might prompt central banks to withdraw stimulus, despite the Federal Reserve saying that this surge should be temporary. The S&P 500 lost 2.14%, the Dow Jones Industrial Average lost 2%, the Nasdaq gave up 2.7% in its largest pullback since March. Yields on the 10-year Treasury were higher after the CPI report. Asian stock markets followed Wall Street lower for a second day on Thursday amid growing worries inflation might drag on in an economic recovery. The Shanghai Composite Index fell 1.26%, and the Nikkei 225 in Tokyo tumbled 2.4%. The Hang Seng in Hong Kong lost 1.54%, the Kospi in Seoul sank 1.33%, and Sydney's S&P ASX 200 was 0.94% lower. Meanwhile, the dollar surged across the board amid higher-than-expected US CPI data. The Euro-USD plunged from the 1.2150 area but managed to hold above the 20 DMA that acted as support early on Thursday as well. Now, the euro needs to regain the 1.2100 figure in order to extend the recovery in the short term. Elsewhere, oil prices briefly surged to the $70 area on Wednesday. A U.S. government report showed that domestic crude inventories fell to the lowest since late February last week, while gasoline supplies rose by 378,000 barrels. The International Energy Agency cut its oil consumption forecast in a monthly report and said that the glut is now just a small fraction of levels seen at the depths of the coronavirus fallout last year. Meanwhile, gold prices on Wednesday logged their first back-to-back retreat this month after a reading of U.S. inflation revealing the biggest monthly increase in 13 years, leading to a rise in U.S. Treasury yields and the dollar. The bullion retreated from the $1,843,000 area to find a local bottom around $1,813. Early on Thursday, the precious metal made some recovery attempts, challenging the $1,820 area ahead of the opening bell in Europe. That is all for today. Thank you for watching. Please click subscribe to always be in touch with the latest market news.